Welcome to the Department of Distance and Continuing Education, University of Delhi, Masters of Business Administration, Semester 1, Core Course MBA FT 6104, Accounting for Managers. Lesson 4, Inventory Valuation. 4.1, Learning Objectives. After reading this lesson, students will be able to understand the concept of inventory, scope of Ind AS 2, concept of net realizable value and fair value, calculate the inventory cost formula for valuation of inventory, when and how to write down inventory to net realizable value, how to write down value as an expense. 4.2, Introduction to Inventory. Inventory refers to the goods which are acquired and held for the purpose of resale in the ordinary course of business or for further processing to make goods for sale. These are not held for administrative purposes. These also includes the consumable supplies such as lubricants, indirect material used in the production or manufacturing of goods for sale in the ordinary course of business. For companies following Ind AS based financial reporting framework, Ind AS prescribes the accounting treatment for inventory and related matters. 4.3, Objective of Ind AS 2. The objective of Ind AS 2 is as follows: to give the accounting treatment and definition of inventories, to provide the guidance on calculating the cost of inventories, to provide guidance on both initial recognition and subsequent recognition as an expense, to provide guidance on write down of value of inventory to net realizable value, to provide guidance on the methods of valuation of inventory such as standard cost method, retail method, to provide acceptable methods of determining cost of inventory such as specific identification method, first in first out method, weighted average cost method. 4.4, Scope of Ind AS 2. Ind AS 2 prescribe accounting treatment for all inventories except for financial instruments covered by Ind AS 32 and 109, which prescribe their accounting treatment. Number 2, biological assets such as living animals and plants related to the operations of agriculture, including agriculture produce at the time of harvest. For these, Ind AS 41 agriculture prescribes the accounting treatment. As per Ind AS 41, inventories which are in the form of agricultural produce that is harvested from the biological asset is to be valued at fair value minus cost to sell on initial recognition. Further, Ind AS 2 is not applicable to the valuation of following inventories. Number 1, inventories of agriculturist and forest products, agricultural produce after harvest, mineral and product based on minerals, because they are valued at net realizable value as per their own well established industry practices. Any changes in their net realizable value is recorded in the P&L or statement of profit or loss in the period of the change. Number 2, inventories of commodity broker traders, because They value their inventories at fair value less cost to sell the commodities such as exchange commission, taxes and other charges. Broker traders are person or entities who buy or sell commodities on the behalf of their clients against commission or on their own account or both. Any changes in the value of such commodities is recorded in the statement of profit or loss in the period of change. 4.5 Some important definitions as per Ind AS 2. Let us understand some of the important terms used in understanding the guidance provided by the Ind AS 2, which are as follows. Inventories. Inventories are tangible assets or items held for the purpose of resale in the ordinary course of business, complete goods or finished goods in case of manufacturer, stock in trade in case of trader, held in the process of further production for selling in the ordinary course of business, that is incomplete goods, work in progress, held as materials or supplies to be consumed in the further production process or in the rendering of services, that is raw material or consumable supplies. Note: costs incurred to fulfill a contractual obligation under a contract with a customer is not treated as inventories. Ind AS 115 Revenue from contracts with customers prescribe the accounting for such costs. Net realizable value. Net realizable value NRV can be expressed in the form of equation given below. Estimated selling price in the ordinary course of business minus estimated costs of completion of work in progress or raw material minus estimated selling costs such as commission, transportation, etc. Therefore, NRV is the net proceeds that a business enterprise expects to receive from the customer through sale of inventory in the ordinary course of business after recovering the cost of completion and incidental selling expenses, if any. Fair value is the selling price of inventory in an orderly transaction in the principal or most advantageous market for the same or identical inventory on the date at which value of inventory is measured. Net realizable value differs from business to business as different businesses sell the same item at different prices. Therefore, NRV is entity specific value while fair value is same for all as it is determined by the free market forces of demand and supply for all the market participants. Note: NRV of inventories might not be equal fair value less cost to sell. Fair value as per Ind AS 113, fair value is the price in an orderly transaction between market participants that would be either received on sale of an asset or paid to transfer or discharge a liability at the date of valuation. Example: X Limited holds inventories of 2 lakh units and it could sell it in the market at rupees 25 each. It has received an order to sell the inventories at rupees 28 each. The incidental selling cost per unit is estimated to be rupees 1 per unit. Here, The fair value is rupees 25 per unit. However, net realizable value is rupees 27, expected selling price 28 minus expected selling expenses 1 rupees per unit. Difference between net realizable value and fair value. Meaning of net realizable value: it is the net amount that a business enterprise expects to receive from the sale of inventory in the ordinary course of business. Fair value: it refers to the selling price of the same or identical inventory in the principal or most advantageous market in an orderly transaction between market participants at the date at which inventory is valued. On the basis of base of measurement, net realizable value differs from business to business as different business sell the same item at different prices. Therefore, NRV is entity specific value. Fair value is same for all as it is determined by the free market forces of demand and supply for all the market participants. 4.6 Measurement of inventories. Inventories shall be measured at the lower of cost of such inventory to the entity and net realizable value of such inventory. Cost of inventories includes all cost of purchase, cost of conversion, direct wages, manufacturing expenses, and other direct expenses such as royalty per unit, and other costs incurred to bring the inventories to their present location and condition such as transportation costs. Cost of purchase includes the purchase price, import duties and other indirect taxes such as GST, other than which are recoverable subsequently from the taxing authorities such as input tax credit in GST and duty drawbacks. Transport and handling charges and other costs directly related to purchase or acquisition of such inventory. Note: trade discounts, rebates, subsidies, if any, are to be deducted from the costs of purchase. Cash discount is not to be considered at all. Example: ABC Limited buys goods from an overseas supplier. It has just purchased 2000 units of component X from the supplier. The quoted price for component X was rupees 1600 per unit, but a trade discount of 10% was given. The supplier gives a cash discount of 2% for payment within 45 days. Import duties or basic custom duties of rupees 80 per unit to be paid at the time of clearance from customs department. Transportation cost of rupees 25,000 to be paid to take the components to the warehouse. Calculate the cost of inventory. Now we have the solution in the following table. First, in the first column we have particulars, in the second column we have amount in rupees. So purchase price, that is 1600 into 2000 into 90%, that is 28,80,000. Import duties 2000 into 80, that is 1,60,000. Delivery cost 25,000. Cost of inventory comes out to be 30,65,000. Cost of conversion include costs which are directly related to the production of finished goods such as direct material, direct labor, other direct costs, and allocation of fixed and variable manufacturing overheads. Fixed production overheads are indirect costs of production that remains constant in amount in the short run regardless of the volume of production, such as depreciation on property, plant and equipment, maintenance charges of factory building, office equipment, laptops, computers, etc., cost of factory management and administration, rent of the factory. Allocation of fixed production overheads to the cost of conversion is to be done on the basis of normal production capacity, which is the average and the expected production over a number of past period under normal circumstances after adjusting the loss of capacity due to planned maintenance, if any. The actual level of production can also be used if it is approximately equal to the normal capacity. If the production levels are abnormally low, unallocated overheads are recognized as expense in the statement of profit or loss of the period in which they are incurred. If there is abnormally high production, then we will take the actual production levels so that the amount of fixed overhead allocated to each unit of production is decreased so that inventories are not measured above the actual cost of production to maintain the principle of prudence. Variable production overheads are indirect costs of manufacturing the finished goods varying directly or nearly directly with the volume of production, such as indirect materials such as lubricant, indirect labor. Variable production overheads are allocated to each unit of output on the basis of actual use of inputs, production resources and facilities. Note: production overheads must be absorbed based on normal production capacity. Note: the process of allocating cost to units of production is usually called absorption. To link the production overhead to some production variable, for example, time, wages, materials, or simply the number of units expected to be manufactured. Other costs. These are the costs which are incurred in bringing the inventories to their present location and condition. These are also included in the cost of inventory. Following costs to be excluded from the cost of inventories and recognized as expense in the statement of profit and loss of the period in which they are incurred. Abnormal wastage of materials, labor or other production resources and facilities. Storage costs such as warehousing charges, cold storage charges, administrative overheads such as salary of permanent office staff, electricity and other utility bills of the office. Selling costs such as carriage outward, sales commission, etc. Ind AS 23 requires that the borrowing cost shall be capitalized on qualifying assets but excludes inventories manufactured in large quantities on a repetitive basis. Inventories manufactured over a short period of time are not qualifying assets. However, in case of producing small quantities over a long period of time, borrowing costs, that is interest on borrowings for financing the purchase or acquisition of such inventories, are to be added in the cost of inventories. An entity may acquire inventories on deferred payment terms, that is, payment to be made to suppliers in future in lump sum or in installments. If the price of the inventory under such terms is more than the price under cash payment mode, then such financing element is to be accounted as interest expense over the period of the financing. 4.7 Measurement of net realizable value. Let us first understand the meaning of net realizable value. Net realizable value NRV refers to the estimated selling price of goods in the ordinary course of business minus the estimated cost of completion of work in progress minus estimated selling expenses. Net realizable value is equal to estimated selling price of goods minus estimated cost of completion minus estimated selling price. If inventories are damaged or become wholly or partly obsolete, or selling prices have declined due to fall in the demand, then the cost of such inventories may not be recoverable fully. In such cases, estimates of net realizable value on the basis of most reliable information available with respect to amount expected to be realized from inventories. These estimates should be made after considering price or cost fluctuations with respect to events occurring after reporting date or after the end of accounting period on the basis of conditions that exists on the reporting date. Estimates should be made after considering the main purpose and objective of holding the inventory. For example, the net realizable value of inventory which is held to supply against firm sales or service contracts is to be determined on the basis of individual contract price agreed with the customers. If the contract for sale of inventory are for quantity which is lesser than the quantity of inventory held by the entity, then net realizable value of such excess inventory to be supplied is determined on the basis of general selling prices prevailing in the market or as per the recent sales contracts or transactions. Inventories are usually written down to net realizable value item by item and not on the basis of classification of inventory into raw material, work in progress, and finished goods. 4.8 Writing inventories down to the net realizable value. Only work in progress and finished goods are to be written down below the cost to their net realizable value. Generally, raw materials and consumable supplies held for use in the production of finished goods are not to be written down below cost till the time the finished goods in which they will be used are expected to be sold at or above cost. However, if due to fall in selling price below the net realizable value of finished products in which raw material or consumable supplies are to be used, then materials and consumable supplies are to be written down to net realizable value by taking replacement cost of such materials as their net realizable value, as these are considered the most reliable and the best available measure of their net realizable value. 4.9 Reversals of write downs. For instance, when an inventory is carried at net realizable value because due to fall in demand, its selling price in the market has declined, but in the subsequent accounting period, and its selling price has increased. In such cases, Ind AS provides the following guidance, which is as follows. Net realizable value is determined in each subsequent accounting period if the earlier circumstances causing inventories to be valued at below cost does not exist, or there are changes in economic circumstances evidencing increase in net realizable value of inventories, then the written down amount is to be reversed up to the amount of the original written down, so that the new carrying value is the lower of the cost and the net realizable value revised. Question: whether the following costs should be considered while determining the net realizable value NRV of inventories. Cost of completion of work in progress, trade discounts expected to be allowed on sale, cash discount expected to be allowed for prompt payment. Question: ABC Limited manufactures and sells paper envelopes. The stock of envelopes was included in the closing inventory as on 31st March at a cost of rupees 50 per pack. During the final audit, the auditors noted that the subsequent sale price for the inventory on 15th April was rupees 40 per pack. Furthermore, enquiry reveals that during the physical stock take, a water leakage has created damages to the paper and the glue. Accordingly, in the following week, ABC Limited has spent a total of rupees 15 per pack for repairing and reapplying glue to the envelopes. Calculate the net realizable value and inventory written down loss amount. Question: at the end of its financial year, Company P has 100 units of inventory on hand, recorded at the carrying value of rupees 10 per unit. The current market price is rupees 8 per unit, at which these units can be sold. Company P has a firm sales contract with Company Q to sell 60 units at rupees 100 per unit, which cannot be settled net. Estimated incremental selling cost is rupees 1 per unit. Determine the net realizable value NRV of the inventory of Company P. Question: a business has 4 items of inventory. A count of the inventory has established that the amounts of inventory currently held at cost are as follows. In the first column we have inventory item, in the second column we have cost, and in the third column we have estimated sales price, and in the fourth column we have selling cost. Inventory item A1, cost 8,000, estimated selling price 7,800, selling cost 500. A2, cost 14,000, estimated sales price 18,000, selling cost 200. B1, cost 16,000, estimated sales price 17,000, selling cost 200. C1, cost 6,000, estimated sales price 7,500, selling cost 150. Determine the value of closing inventory in the financial statements of a business. Now, net realizable value for raw material can be understood with the help of the following figure. Material and other supplies held for use in the product of inventory. So we have two cases. When the finished goods are sold at or above cost, then raw material is valued or measured at cost. When the finished goods are sold at NRV, raw material is measured at replacement cost measured as NRV. Now consider the example. We have first particulars, then quantity in kg and rupees. Opening inventory finished goods of 1000 kg, amount is 25,000 rupees. Raw material of 1100 kg, amount is 11,000. Purchases of 10,000 kg, amount is rupees 1 lakh. Labor amount is 76,500. Overheads fixed amount is 75,000. Sales of 10,000 kg, amount is rupees 2,80,000. Closing inventory of raw material of 900 kg and finished goods of 1200 kg. The expected production for the year was 15,000 kg of the finished product. Due to fall in the market demand, the sales price for the finished goods was rupees 20 per kg and the replacement cost for the raw material was rupees 9.5 per kg on the closing day. You are required to calculate the closing inventory as on that date. Question. Example. Sun Pharma Limited, a renowned company in the field of pharmaceuticals, has the following four items in inventory. The cost and net realizable value is given as follows. Item A, cost 2000, net realizable value 1900. Item B, cost 5000, net realizable value 5100. Item C, cost 4400, net realizable value 4550. Item D, cost 3200, net realizable value 2990. Total cost 14,600 and net realizable value 14,540. Determine the values of inventories on an item by item basis and on a group basis. 4.10 Recognition as an expense. The amount of inventories to be recorded or written off as an expense in the accounting period will usually be: first, carrying amount of the inventories sold in the accounting period in which related revenue is recognized in the statement of profit and loss or income statement, and the amount of any written down of inventories to their net realizable value and all the losses of inventories thereof shall be recorded as an expense in the accounting period in which the written down or the loss occurs, reduced by the amount of any reversal in the same accounting period of any written down of inventories due to increase in net realizable value shall be recorded as an reduction in the amount of inventories recognized as an expense in the period in which the reversal occurs. Some inventories may be allocated to other asset account. For example, inventory used as a component of self-constructed property, plant or equipment. Inventories allocated to another asset in this way are recognized as an expense during the useful life of the asset through charging of depreciation on that asset. Example, an item of inventory costing rupees 20,000 as covered under Ind AS 2 is consumed in the construction of self-constructed property to be accounted as property, plant and equipment under Ind AS 16. The cost of such property, plant and equipment other than inventories is rupees 80,000. Such inventory needs to be capitalized in the cost of property, plant and equipment. The useful life of the property is 5 years. The depreciation on such property charged to P&L is rupees 20,000 per annum, that is 1 lakh divided by 5. 4.11 Disclosures. The financial statement shall make the following disclosures with respect to inventories. Number 1. Accounting policies with respect to valuation of inventory. Inventories pledge as security for raising funds, detailed analysis of carrying amount of inventory classified into its components or categories, amounts recognized in statement of profit or loss as expense during the current year, inventory carried at fair value less cost to sell. So the disclosure can also be understood through the following figure: accounting policies, inventories pledged as security, amounts recognized in profit or loss, analysis of carrying amount, inventories carried at fair value less cost to sell. 4.12 Summary: inventories are tangible items which are held for sale in the ordinary course of business, that is, finished goods, held in the process of production for further processing so that they can be sold as finished goods, that is, work in progress, in the form of raw materials or consumable supplies to be consumed or utilized in the production process or rendering of services to the customers. Net realizable value is the estimated selling price of the goods in the ordinary course of business minus estimated cost of completion if the goods are not ready for sale as such, minus estimated selling costs such as distribution expenses, selling commission or transportation expenses. Fair value is the selling price of same or identical inventory in the principal or most advantageous marketplace between market participants in an orderly transaction at the date of measurement. Inventories or closing stock shall be valued at the end of each accounting period at the lower of cost of inventory or net realizable value. Disclosures to be made in financial statements with respect to inventory. Number 1, accounting policies. Number 2, inventories pledge as security. Number 3, detailed analysis of carrying amount into its components. Number 4, amounts recognized in the statement of profit or loss. Thanks for listening the lesson.